Good morning, everyone. Welcome to my channel, Corporate Bytes. And today I'm your trainer, Kabir Khan. Today I thought of discussing about the one of the important topic that is the accounting cycle. So let's get started. Let me share my screen. Yeah. So let's get started. So today we will be discussing about the accounting cycle and the students who is pursuing for the CACPT or ICWA or even the BCom first year. For those students, I think this session will be very, very useful because we will be discussing the accounting cycle from the scratch. So let's get started. So before we understand the accounting cycle, so let's first understand what is the meaning of the accounting. So here accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money, transaction and events which are in part at least of a financial character and interpreting the results thereof. So accounting, why we'll call the accounting is the art of recording? Because accounting is considered as an art because only the accountants can post the journal because they are aware of what needs to be debited, what needs to be credited. For that purpose, accounting is considered as an art of recording. Second is the classifying. When we see the word classifying, it means like the transaction of the similar nature must be booked to one ledger. For example, purchases should book to the purchase ledger, sales should be booked to the sales ledger. So we will classify the transaction as per their nature. So second is the classifying. And the third is the summarizing. When we say the summarizing here, the summarizing is nothing but the reporting of the financials. So we have the income statement and the financial statements. So when we talk about the income statement, we have the trading and the profit and loss account. And we will discuss about the financial statement. We have the balance sheet and the cash flow statements. So summarizing, and which transactions do we record in the accounting? Only the monetary transactions should be recorded in the books of accounts. Non-monetary transactions should be excluded. For example, any transaction which we can express in terms of money should be recorded. For example, if I say hardworking employee, so this transaction we cannot express in terms of money. So this type of transaction, non-monetary transaction, should not be recorded into the books of accounts. So let's move to the another slide. Yeah. So let's discuss about the accounting cycle. So what does this accounting cycle, what all steps are there? Let's get started. Yeah. When we are talking about the accounting cycle, the first step is the journal. Second is the ledger. Third is the trial balance. Fourth is the income statement. And the fifth is the position statement. So let's understand each of these in detail. Yeah. So firstly, let's get started with the journal, meaning of the journal. So the word journal is derived from the French word, which means a day. A journal, therefore, is a book in which transactions are recorded daily in a chronological order. I mean, the order in which they occur. For that reason, we will call it like chronological order. A journal is called a book of prime entry or the original entry because all the business transactions are entered first in this book, from which it is posted to the ledger. And the process of recording the transaction in the journal is called journalizing, and the entry made in the journal is called the journal entry. So the word journal is derived from the French word, which means a day. For that purpose, we will record day-to-day transactions into the journal. And it is also called as a book of the prime entry. And here, for just for an example, I have give the example of how we record the journal. So we have the date, particulars. This folio is nothing but the ledger folio, debit amount, and the credit amount. So this is just an example of the credit sales entry what I have attached as an example. So this is the credit sales entry, and this is how we record in the ledger. So the one of the most important, I think, CPT question is like all the columns are filled below except the ledger folio. So when we are booking the journal, so in the journal we will add each and every column. We will put the details in each of the column except the folio, which is the ledger folio column. And this column we will add at the time when we are transferring the balances to the ledgers. So for that reason, I have added the point. All the columns are filled below except the ledger folio column. And we will record the transactions in the chronological order. I mean, in the order in which the transactions occurs. So let's move to the another ledger. What does this ledger means? A ledger is a principal book which contains all the accounts to which the transaction recorded in the books of original entries are transferred. So ledger is the principal book, and in ledger we will transfer the balances from the journal to the ledger, and the process of transferring the balance is called posting, and this may be done daily, weekly, fortnightly, or monthly. As ledger is the ultimate destination of all the transactions, the ledger is called the book of the final entry. It is considered as the permanent record. So it depends on the organization and the transaction flow, and it depends on the management, like what they have decided to move the journal balances on a daily basis to the ledger, or on a monthly basis, or a weekly basis. So it depends on the organization to organization, and this ledger is considered as a permanent record. So in the ledger we have total 8 columns. Date, particular, here we have journal folio. In journal we have ledger folio, but in the ledger we have journal folio. So here we will add the journal folio number and then amount, and then we have two things, debits and the credits. So total 8 columns are there in the ledger. Now next move to the trial balance. So we all know once we book the entry into the journal and then we have transferred the balances to the ledger, then we will prepare the trial balance. So a trial balance is a statement of debit and credit totals, or the balances extract from the various account in the ledger and the cash book, with a view to test the arithmetical accuracy of the book. For example, if the accountant recorded credit purchases to the credit sales and credit sales as a credit purchases, then those type of errors can be captured while preparing the trial balance. The main purpose of preparing the trial balance is to identify the errors and to make sure that our books are arithmetical accuracy. So our books are with the arithmetical accuracy and no errors are there in our transactions. The agreement of the trial balance revealed that both aspects of each transaction have been recorded and the books are arithmetically accurate. If the trial balance does not agree, it shows there are some error which must be detected and rectified if the correct final accounts are to be prepared. Trial balance forms a connecting link between the ledger and the final accounts. The trial balance is a statement and not an account which is prepared on a particular day and not for the particular period. So trial balance act like a bridge in between the ledger and the financial statement, final accounts. And it is a statement, not an account. Trial balance is just a statement of debit total and the credit total. It is not an account. It is just a statement which is prepared on a particular date and not for the particular period. And there are certain errors which cannot be fixed by the trial balance also. So even though the debit and credit totals tallies, but still there might be a certain errors which cannot be captured in the trial balance. So those we will understand in the another chapter called the rectification of errors. So what are all the different kinds of errors we may come across, like error of commission, error of omission, error of deletion, like that. So all those errors we will discuss in a separate chapter called the rectification of error. For now, trial balance act like a bridge between the ledger and the final accounts, and it is just a statement, not an account, which is prepared on a particular date and not for the particular period. So let's move to the another. Yeah. Next, we have the income statement. So income statement, we have two things. One is trading account. So trading account is one of the financial statement which shows the result of buying and selling of the goods and services during an accounting period. So trading account is prepared. So we have two accounts, trading account and profit and loss account. So trading account is prepared in order to find the gross profit of an organization, whereas the profit and loss account is prepared in order to find the net profit. So there is a difference. Trading account is prepared in order to find the gross profit, and the profit and loss account is prepared in order to find the net profit. how much gross profit we occurred during the accounting period and how much net profit. So the trading account is prepared to know the gross profit during the accounting period. The basis of the preparation of this account is to match the selling price of the goods and services with the cost of goods sold. So we all aware, we will discuss about the cost of goods sold in a separate chapter. We have the opening stock plus direct expenses minus closing stock. So all these formulas we will discuss in the later. So, but for now, the main reason of the preparation of this account is to match the selling price of the goods and services with the cost of goods sold and the services rendered. Next, we have the profit and loss account. This is also the financial statement. So trading account and profit, both are the financial statement only, but profit and loss account represents the financial performance of an enterprise during the accounting period. It shows the financial performance during the accounting period. The profit and loss account is prepared to ascertain the net profit earned or net loss incurred by an enterprises. So trading account is prepared in order to find the gross profit or gross loss during an accounting period, whereas the income statement is prepared in order to find the net profit or the net loss incurred during the accounting period. And both are the financial statements. Yeah, we have certain formulas on the income statement. So first understand the gross profit. Gross profit is nothing but the operating revenues minus direct operating expenses. That's the formula of the gross profit. And net profit, we have all revenues, whether it is the operating or non-operating, and minus expense and losses is. So net profit can be ascertained by deducting expenses from the revenues, and the revenue or expenses may be either the operating expense or revenue or non-operating expense or revenue. Now we have the operating profit, operating revenue minus operating expense loss. It arises as a result of carrying out the operating activities. So when we are saying operating profit, then we need to consider only the operating revenue and the operating expenses. Here, let's understand operating activities are the principal revenue producing activity of an enterprise, another activity that not investing or financial activities. For example, here sales and purchases of a building by the builder and the property dealer are the operating activity. So if there is a dealer who is dealing in the real estates, who is buying and selling the buildings or the plots, or so for that dealer, so buying and selling of the buildings or the flats are considered as an operating activity. In the same way, if there is a computer dealer who is dealing in the buying and selling of the laptops, so for that dealer, laptops are considered as an operating activity. Granting loans to the third parties by them are investing activities. Taking loan from the third party are the financial activities. So if any organization is giving the loans to the third party, that will fall under the investing activity. But if they are taking the loan from the outsider, then that is considered as a financing activity. So let's move to the balance sheet. Yeah. So we discuss when we are talking about the financial statement, there are three: trading account, profit and loss account, and third is the balance sheet. A balance sheet is one of the financial statement. A balance sheet is the only statement and not an account. This is also just an statement, not an account. It has no debit and credit side. The heading of the two sides are the assets and the liability. So here we don't have any debit or credit, but we have assets and liabilities. A balance sheet is prepared at a particular point of time and not for the particular period. The information contained in the balance sheet is truly only at that particular point of time at which it is prepared. Balance sheet is summary of the balances of those ledger accounts which have not been closed by transferring to the trading and profit and loss account. Yeah, so there are three types of accounts: personal account, real account, and nominal account. We all are aware of this one. So we all know, like, the nominal accounts are closed by transferring those balances to the profit and loss accounts, but real and the personal accounts are moved to the balance sheet. So for that purpose, I mentioned a balance sheet shows the nature of the value of asset and the nature of the amounts of the liabilities at a given date. And a balance sheet is summary of those balance of the ledger accounts which have not been closed by transferring to the trading and the profit and loss accounts. So remember, here we have three types of accounts: personal account, real account, nominal account. So all the nominal balances will close by transferring those balances to by moving to the profit and loss account. But the personal account and the real account are not closed. So that's the only point we need to remember here.